Bitcoin overview and market structure. Bitcoin remains the primary liquidity hub of the crypto market. Most altcoin risk appetite and broad crypto liquidity conditions typically follow Bitcoin trend and volatility. The asset behaves like a high beta macro proxy during risk-on phases, and like a liquidity stress indicator during risk-off phases, because leverage and stablecoin flows amplify moves in both directions. A useful way to think about Bitcoin is as a three-layer system: spot demand and supply, derivatives positioning, and liquidity conditions in the broader dollar system that affects marginal risk-taking. Spot dynamics and supply considerations. The long-term supply schedule is relatively inelastic, so medium-term price formation is usually driven by changes in marginal demand rather than changes in production. In practice, marginal demand comes from a mix of long horizon holders, corporate and treasury-style allocations, exchange-traded products where available, and shorter horizon traders. When spot demand is persistent, the market tends to grind higher with contained drawdowns. When spot demand is absent and derivatives are crowded, the market tends to experience sharp downside moves that flush leverage and reset positioning. On-chain and flow-based signals to watch. A practical framework is to track exchange net flows, realized profit-taking behavior, long-term holder supply changes, and stablecoin issuance and redemption trends. Rising exchange inflows often precede higher sell-side pressure, while persistent exchange outflows can be consistent with accumulation and reduced liquid supply. Spikes in realized profit-taking after strong rallies can signal distribution and a period of consolidation. Growth in stablecoin supply can support risk asset liquidity. Contraction can signal tighter conditions. None of these signals are perfect in isolation. The edge comes from how they align with price action and derivatives data, derivatives positioning and volatility. Bitcoin price often moves to resolve imbalances created by perpetual swap funding and open interest. When funding is persistently positive and open interest is rising, it indicates traders are paying to stay long. That can be healthy in a strong uptrend, but it can also create fragility because a negative catalyst can force liquidations. When funding turns negative while price holds or rises, it can indicate a more resilient rally driven by spot demand and short covering. Options markets add another layer: elevated implied volatility relative to realized can indicate expensive protection and can sometimes precede calmer periods, while low implied volatility can indicate complacency and can precede volatility expansion. Technical structure without relying on a specific live price. For Bitcoin, the most actionable technical reference points are major prior cycle highs and lows, the all-time high zone, and long-duration moving averages such as the 200-day and the 20-week. In sustained bull phases, pullbacks that hold above the 200-day and reclaim the 20-week often mark continuation. In bear phases, rallies that fail near these same references often mark distribution. Volume profile and the notion of high volume nodes versus low volume air pockets matter. Breakouts from low consolidations tend to travel quickly through low participation zones, while high participation zones tend to act like magnets that pull price back for retests. Regime identification and what to do with it. A disciplined approach is to classify the environment into one of four regimes: trending up with rising liquidity, trending up with tightening liquidity, trending down with tightening liquidity, and main reverting range conditions. In trending up with rising liquidity, trend following and buying pullbacks tends to work. In trending up with tightening liquidity, position sizing matters. Upside can continue, but drawdowns can be sharper and more frequent. In trending down with tightening liquidity, capital preservation and selective exposure dominate. Short volatility strategies tend to break, and liquidation cascades become more likely. In mean reverting ranges, selling extremes and buying support with tight risk controls can outperform, but breakouts must be respected when volume and funding align. Key risks specific to Bitcoin. One risk is liquidity gap risk, where price moves quickly through levels with limited resting bids, often during off hours. Another is policy and regulatory headline risk, which can change access and leverage conditions. A third is custody and exchange risk, which affects the safety of holding and moving Bitcoin. A fourth is correlation shock risk, where Bitcoin becomes highly correlated with equities or rate-sensitive assets for a period, reducing diversification benefits. The final risk is narrative crowding, when a dominant story attracts leverage and the market becomes one-sided. Practical execution and risk management for Bitcoin. A robust process starts with position sizing based on volatility, not conviction. Define invalidation levels before entry and avoid widening stops during adverse moves. Consider scaling into positions in tranches rather than single entries, and take partial profits into strength when funding and sentiment become euphoric. If using leverage, treat it as a tactical tool for short windows, not a strategic default. For long horizon exposure, prioritize spot holdings in self-custody or reputable custody solutions, and treat derivatives as hedging instruments rather than core exposure. Now, USDT analysis. USDT is designed to track the value of one United States dollar and is primarily used as a settlement asset and liquidity rail across exchanges and networks. Its market role is closer to cash-like collateral than a risk asset. That said, USDT has meaningful risk dimensions that differ from traditional bank deposits, and those risks show up most clearly during market stress, regulatory shifts, and when redemption or settlement channels become constrained. PED mechanics and why it usually holds. The PED is supported by arbitrage and redemption mechanisms. When USDT trades below $1 on exchanges, arbitrageurs can buy discounted USDT and redeem through authorized channels, capturing the spread, assuming redemption is accessible and timely. When USDT trades above $1, users can mint or acquire USDT more efficiently and sell at a premium, which can pull the price back down. In normal conditions, deep liquidity and broad acceptance keep deviations small and short-lived. What actually matters for USDT risk? The most important drivers are reserve quality and liquidity, operational resilience, banking and payment access, and regulatory exposure. Reserve quality is about what backs the token and how quickly those assets can be converted to dollars under stress without material loss. Operational resilience is about whether issuance and redemption continue smoothly during high demand. Banking access is about whether the issuer and its counterparties can move dollars reliably. Regulatory exposure is about whether policy actions restrict usage, listings, or settlement pathways. Market stress behavior and debit scenarios. USDT can deviate from $1 during panic, usually to the downside if holders rush to rotate into other forms of perceived safety, such as actual bank dollars, short-dated government money market instruments, or other stablecoins. A mild dip often reflects temporary liquidity imbalance on specific venues. A larger or persistent dip tends to reflect impaired confidence and/or impaired redemption access. In severe stress, stablecoin markets can exhibit reflexivity. Price weakness drives fear. Fear drives more selling, and the on-chain and exchange liquidity cannot absorb flow without a discount. Relative positioning. versus other stablecoins. USDT often has the deepest trading pairs across many global exchanges and networks, which supports its utility. But utility is not the same as risk-free. Some alternatives emphasize different trade-offs, such as higher transparency, different reserve structures, different regulatory footprints, or more limited distribution. From a portfolio perspective, concentration in a single stablecoin is a single point of failure risk. Diversifying stablecoin exposure and minimizing idle balances on exchanges can reduce tail risk. Using USDT as a tool rather than a thesis.